Hello and welcome to our Yardi Matrix Self-Storage National Outlook on September 1st, 2021. My name is Megan Furr, your producer for today's program. We are joined today by our hosts Jeff Adler and Chris Nebenzahl. Our program will run about an hour and we hope you can stay with us for the entire broadcast. We want this to be an interactive conversation, so please feel free to submit questions in the Q&A icon at the bottom of your screen, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Please note that what we discuss today may or may not be relevant to your situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decisions. Now, I am pleased to welcome Chris Nebenzahl, Editorial Director, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Megan, thank you so much. We are joining you today from Chicago. We are at the National Apartment Association. And next week, I will be at the SSA in Las Vegas. Look forward to meeting up with you all there. Anyway, so let's kind of run through kind of what we're going to cover today. I'll go over a macroeconomic outlook and give you kind of an overview of what's going on in the economy and a little bit of a view of migration and cross-sectional views across asset types. And then I'm going to turn over to Chris, when we'll really go into what's going on with a deep dive into street rates and storage fundamental performance and many of the things that we kind of covered in the past. So we've got some new material for you, and I hope it continues to add value. So first, just as like an overview of kind of what's going on. The economy is pretty darn strong. Employment's pretty good. Rising inflation is a bit of a concern we're going to be watching. Self-storage demand remains at very, very high levels. And as a result, street growth is historically very high. Almost all markets showing some growth. New supply pipeline is kind of in check. It's robust, but it's in check. And that means that investor interest, because the operating results are so good, is very, very high. And from my perspective, the outlook's quite good. The question mark we're kind of running through here is, how long does this elevated demand? Is it a permanent shift in the demand curve, or is it a bit more transitory? And that will kind of give us a view as to how long the good times roll. Okay, so let's kind of get into this then. So from an economy, economic standpoint, the economy is in a significant recovery mode and in a growth mode. Third quarter GDP view is a 6% number. There's some choppiness going to have with the Delta variant, but the bottom line is we're on a trajectory of opening, though it's going to get a little choppier come the fourth quarter. And then we kind of expect that to, as we kind of view here, it's a V-shaped recovery. There's no question about it being V, it's not a U. But there are significant sort of tailwinds. The monetary stimulus, the continued reopening, a surge in consumer net worth, significant multi-trillion excess savings and inventory rebuilding. Again, think of that as there's some choppiness in the fourth quarter, but if you view this sort of over the course of the next couple of years, you've got an increase in growth and then kind of a trailing down in growth. And we would expect this, 7% forecast in 21, 22 forecast of 4, and then kind of maybe going back to 3 and then eventually to 2.5. The question mark is the deflator, how long that hangs in there. We'll kind of walk through a little bit of that in a second, and then what happens with interest rates. Certainly, the Fed's not going to taper until the tail end of this year, early 22. Interest rates not going up till 23. I think we were sort of reasonable on the bond yields and the cost of money, but I think overall, we're kind of moving forward. There has been a rebalancing as we expected, away from goods towards services, but that's been, again, a little choppy, but there's still a lot of excess stock of goods, which are going to have to be stored. And that will continue to drive demand for storage. Consumer spending, as we expected, is kind of coming back, but we also have these labor shortages and disruptions in the supply chain for services, car rentals, as an example, hotel services, restaurants, kind of that issue of disruption. Now, as you look at inflation, and we've kind of broken this down, this chart would support the Fed's view that it's kind of a transitory issue, that if you strip out base effects and you strip out some sensitive items, as we kind of noted before, lodging, used cars, car rentals, airline fares and such, that, this will all kind of like work out in the wash. I'm not quite there. So we'll go into the slide there. Is yes, that's largely true with some meaningful caveats. Unemployment and underemployment is continuing to fall. I think it will continue to fall in the fourth quarter. The unemployment going away, I think, will help on the lower end return people to work. I would say, though, that there's so much disruption that one of the benefits was the reopening of schools and the reopening of childcare centers that would enable more people at higher wages to go back to work. And that is under threat. There are severe labor shortages for some of these childcare services. And given the fact that it doesn't pay all the way in the first place, that is an impediment to reopening the economy. Another sort of impediment to reopening the economy is the labor force participation rate. While it's recovering, the biggest drop-off we've seen is among older Americans. And again, we had been banking on older Americans to continue to work longer in order to reduce and to mitigate the impact of demographic aging and reduced immigration. And they kind of took a little bit of an off-ramp. And that is also compounding some of the issues related to the labor force. Now, if you look at earnings, as we would expect, the markets that are trying to reopen the most are the ones that are seeing the highest wage pressure: leisure and hospitality. That's a pretty good increase. Transportation and warehousing, because there's a need for that labor, and retail. Less so on infotech and other areas that had been doing fine the whole time. And then if you look again at where the changes are relative to the sectors, right? So lower wage workers are seeing fast wage growth. They've got a lot. They also have wage destroyed in the downturn. There's lots of new jobs at that level. Jobs are absolutely begging. Eventually, automation will catch up with this, right, in order to sort of replace the need for those workers. But we're in a period of disruption where the demand for workers at this end is way higher than the supply, and supply has been constricted. And so you've now got like some issues with the supply of services that allow that economic sector to grow. So taking all that together, the economy is recovering quickly. It varies across state due to state policies. It varies due to sectors. We're going to be watching inflation. I am a little concerned about inflationary expectations on wages. Right now, we're not seeing a large-scale shift among the 95% of employed Americans that mean that they basically will require or expect higher wages than 2 or 3%. So that's really something to be careful. The stage is set for a potential inflationary spiral, but we're not there. At least we're not there yet. And self-storage is holding up really well. So let's kind of go into a bit of a dive into street rates.
All right, and we'll launch our first poll question. Feel free to take part in the poll right there on your screen.
Something new. We haven't done
something new.
We haven't done this before.
Our first foray into polling. So it looks as the results are coming in, a lot of folks are interested in acquiring new, some on the development side. And it doesn't look like there are too many net sellers
But that's a problem.
that is a problem because there's a lot of money coming in, and we'll talk about this in a little bit, Jeff, but
right.
There's a lot of interest from outside capital.
Right. So if you look at, that's an interesting kind of a balance, and it's kind of balancing, I'd call it around, 50% acquisitions, right? 40% development. For development takes a little bit longer to sort of impact the supply situation, but will eventually be there, and a little bit of rebalancing and selling. So really interesting. Okay, well, that was pretty cool. All right.
Let's continue on.
I'm going to share the results. There you go.
And so, yeah, as you said, Jeff, about 52% in the acquisition phase, 37% in development, and 10-12% looking to rebalance.
Pretty cool. All right, well, let's
all right.
That was interesting. Let's go to the next one. All right. So just to remind you, in terms of how we think about markets, we've taken stab of all of our 135, 40 markets and cut them between major markets and tertiary markets. And so understanding the context here is there's a number of, we've always called the COVID as the great accelerator. It has accelerated a lot of things. And we've also talked about the reversal of trends. Experience over things have been reversed. Densification has somewhat been reversed. Globalization has somewhat been reversed.
All of these helpful to the, or many of these
helpful
to the
storage industry. Exactly. And if we look at this in terms of gateway markets, right? This is sort of a little bit on the old news side, but it is this effort of the core cities depopulating, migration, while core cities, as we'll see, the younger population is coming back. The movement of people from higher cost areas to lower cost areas isn't done yet. And we can see that in the major markets. And if you take a look at smaller markets, you see much the same thing. Spokane being a big beneficiary of that, but the same trend, right? Spreading out of the population to more places, and that movement of people generates demand. And we've kind of seen that from some survey data that Storage Cafe put together for us. It's the key driver of storage demand, even though people think they're only going to keep it for 6 months or less. The trend that we already saw, right? Remember, we already saw movement of people. The tax code in 17 had already started a migration out. The high cost of real estate had already started a migration out. And all of this was really a question of acceleration. And you can kind of see all the markets that have benefited. Sacramento, you have spillover markets like Inland Empire and Sacramento within California. And then you have all the Western markets, all the Southeastern markets, all the Texas markets really benefiting from migration of people. And quite frankly, also the cascading of people, even within Florida, from Miami to Orlando to Tampa.
Well, and Jeff, this isn't just self-storage. I mean, we're seeing this in our multifamily data as well, right?
Exactly. And so here's a kind of a chart of what's going on even in the core market. So this is kind of a focus on core markets, the core markets in multifamily with the laggards, right? All the other gateway markets, they've got rents on a cumulative basis since COVID hit of up 20% or more on a cumulative basis. And just the August data that you and I looked at today, or about to release, will show surveyed rents in multifamily up 10% on a year-over-year basis, just killing it. All right, and while the gateway markets were the last to come back, just about all of them actually are back, except Manhattan and San Francisco. They're the laggards, but the other markets kind of are recovering as well, but at lower rents. So the other thing I kind of wanted to set here as a context is that the work from home trend and the movement of people isn't over yet. There's more to be played out. Also, the supposed reopening because of the Delta variant that has been pushed off, right? And now you're going to be close to 2 years of people working in a non-everyday office environment, and a lot has changed. A lot has been moving, and people are still moving. There's still movement of populations from within metropolitan areas to the fringes of those metropolitan areas to different metropolitan areas. There's some movement of young adults back into major cities. We're seeing that for sure. But all of that movement, I mean, when it comes to storage, all of that movement is amazing because it generates demand. And then when that demand happens, it tends to be a tad stickier than people's expectations of it was, because things just take longer, right? So all of that has, in my mind, it created a shift, a demand curve shift in storage in a meaningful way. And remember, we also have household formations, right? 2020, we actually saw a reduction. We're seeing a shot out of the can in 21. And yes, demographically, we expect household formations to tail down, but that's still a fair amount, again, of storage needs. New households, as well as the movement of households, is one of the bigger issues, I would say. So I'm going to now shift this to you, Chris, as we get into what's going on below a little bit of the surface.
Great. Thanks, Jeff. And as you mentioned, we're really going to drive home the main point here of what's going on with demand, this shift in demand that you talked about, the increased utilization. We've really gone through an interesting time in storage where overall utilization of storage as a product is up significantly. And the question remains, how long is that utilization going to continue? How sticky is this asset class? What we've seen historically is it's a very sticky asset class. And we hope that continues. We expect that to continue, probably for at least another 18, 24 months, but perhaps even longer. And so what are some of the big drivers that we've seen for this increase in utilization? Certainly to facilitate remote learning, working from home, as Jeff mentioned, people were clearing out rooms, multiple rooms. They needed to store their guest bed, their furniture, their couch, whatever might have been in there. So that's been a big driver of storage. Greater emphasis on outdoor activities. We haven't been able to gather, we haven't been able to socialize together. So people have been buying boats, RVs, motorcycles, ATVs, expensive toys that they need a place to store. Migration.
And by the way, I'll come back to that topic at the end, because we're gonna be doing something about that too.
Absolutely, great. And then migration, as Jeff talked about. Any migration, inter-metro, intra-metro, intrastate, the fact that people are moving always creates demand for storage. And we, as Jeff mentioned, we were looking at some storage cafe data. The vast majority of people who are using storage, they're doing it for relocations or they're doing it to clear up space in their home. Interestingly enough, there is also a little bit of a demand from business. I'd say it's on the margin, but it's not immaterial. 5-10% businesses using storage for inventory purposes, restaurants, retail shops that had to kind of change the way their facility was operated. That drives demand as well. So as Jeff mentioned,
Chris and Jeff, we had a question come in.
yeah, go ahead.
Related to migration, do you know where folks moving out of New York City and San Francisco are moving to? I've heard the greater Seattle area is high on the list from those two areas, but what are you seeing?
The biggest migration, and really there's these were pre-existing migration corridors. So out of New York or the Northeast, right? New York, New Jersey, Connecticut, you really saw a migration down to the Carolinas, Tennessee, to Florida, right? So there's significant, again, these were pre-existing migration corridors out of Chicago into Tampa and Orlando. And California, it's really fanned out over the entire West. So I could go from Boise to Reno, to Salt Lake City, to Vegas, to Phoenix, to Lesser, to Denver, to Albuquerque. It's been a fanning out. Seattle has benefited a tad, but Seattle downtown got hit pretty hard in terms of on the multifamily side of a migration outward for both cost reasons and work from home reasons and a little bit of public safety reasons as well. And they're also benefiting. Downtown Seattle has benefited from the recovery, just like a equivalent international gateway city. So I think there's been a movement of people within the Seattle metropolitan area. But I don't think that Seattle has benefited as much as migration from California as in the past.
I'd throw in the Texas markets too, Jeff.
Sorry,
they're getting it from California and the Northeast, where Austin is a mini San Francisco, yes. Dallas, Houston, you're getting a lot of in-migrants.
Well, excellent point. I apologize for overlooking it. Absolutely true.
So as Jeff mentioned at the top of the program, for the first time, we're going to take a deeper dive into street rates. Usually we just cover the 10 by 10s, but we noticed a trend, again, going back to some of the drivers of demand with people clearing out entire apartments if they were relocating or significant portions of their home, that the demand for the large units, the 10 by 30s, has really increased. When you look at a lot of these migration hotspots, Nashville, Tampa, Orlando, Phoenix, Denver, Dallas, Fort Worth, significantly larger increases in the large units, the 10 by 30s, than there are in the lockers, in the 5 by 5s, the 5 by 10s. And now don't get me wrong, there has been significant street growth across the board, right. and we're going to look at that. But right. We noticed a trend that the bigger units seem to be doing a little bit better in most markets, not all markets, but in most places. So again, breaking things down by street rate growth by unit size, Miami, Sarasota, Charleston, again, some of these southeastern markets doing really well in the small market growth year over year, or sorry, small unit size growth year over year. And we're going to see the same names: Miami, Sarasota, Atlanta, Inland Empire, as Jeff was saying, the relocation. They're leaving California, but they're also leaving LA just to go to the Inland Empire. A little bit cheaper, a little bit more room, and you see the significant increase in the medium-sized units here as well. And then finally, with the large units, again, significant increases. A couple, markets, Providence, Bridgeport, those markets to me sound like people who are relocating out of Boston or storing their things out of Boston and New York. They might be coming back. We did a quick analysis on Manhattan. 10 by 30s in Manhattan are going for about $1,000 a unit right now. So if you were thinking, okay, I'm going to leave the city, I don't know if I want to pay $1,000
a month.
I might go store my stuff in Connecticut. Whenever I come back, if it's in a year, if it's in 2 years, then I'll go get it. So a little bit of growth here on the large units. Again, that's where you empty your whole apartment. You need a 10 by 30. And that's what we're seeing there. Another interesting little bit that we added in is looking at street rates versus our industrial rent growth. Industrial has been on a tear as well. Storage and industrial. Jeff, tell me if I'm wrong, but those are probably the two best asset classes in commercial real estate.
Well, if you think about the sort of the stars for large institutional investors, industrial, multifamily, self-storage has been thought of as a specialty asset class, but industrial's been on a tear with large spaces being taken down and properties being converted to e-commerce locations. So it's interesting, right, that you're seeing here, right, the industrial square footage costs are going up a lot. And then you're also seeing the same thing happening with the large storage units, most applicable for business uses as needed. So
small businesses that might not want a full industrial space.
They can't take the space down, or if they did, they're going to maybe being priced out by the industrial uses, and they're using storage as a replacement.
Yep, absolutely. So what we're looking at here is the newer construction. So again, when we get back to utilization, there have been a number of new users to storage. Perhaps they didn't need it before, perhaps they didn't think they needed it before. And so most of those new renters, we think, are likely to go to some of the newer facilities. A little bit shinier, a little bit more advertising. They see it right there in their neighborhood. And what we've seen is that the newer construction has really accelerated the most. Properties built 2008 to today, not quite as expensive, but the acceleration, the growth has been a little bit quicker. Same kind of concept with what we consider A improvement ratings. Those have been accelerating the fastest. Again, new users are probably going to go to the A quality ratings.
If you think about this as new users who also have meaningful levels of income, right, who are moving one way or the other, right, are more prone to be willing to pay a little extra, right, as opposed to the spare garage, right, because maybe they've got the means to do so, and they have higher quality expectations, and Class A and newer properties have been the beneficiaries.
Yeah, absolutely. And so we get back to kind of our marquee slide that we've shown in all of our webinars, our self-storage bubble chart. And one of the questions for any return viewers you might be saying is, Jeff, Chris, what happened to the red and the yellow?
They're gone.
They're gone. They're gone. And for years, we had been talking about how street rates were slowing down. They were negative. In-place rents were keeping the self-storage industry alive. But what we've seen really in the past, I'd say 12 months, this is year over year numbers, is a return to incredible strength, incredible growth across the street rate perspective. And you might say, okay, Chris, well, what about the fact that rents were down during COVID, and this is just a bounce off of a weak summer last year? Going back to March 2020, all of our top 30 markets are above their March 2020 levels for street rates. And some of these markets, Chicago, 21% off of their pre-COVID levels, above their pre-COVID levels. Philadelphia, 20%, Miami, 19%, Inland Empire, 19%. So it's not even that there was weakness at the pandemic and we're recovering.
But that also very much aligns with the trend in multifamily rents too, right? I would say with the exception though is, so that aligns with the trend in multifamily rents for tech hubs. It's far superior for the international gateway cities, like Chicago's, the Philadelphia's, the Miami's.
And that I think is a great point, Jeff. That gets back to the whole idea of migration. If people are moving anywhere, that's a really good thing for self-storage. We look at our tertiary markets, as Jeff explained at the beginning, the difference between our primary and our tertiary markets An interesting thing I'd point out here is Baton Rouge. You see down in the bottom right. We know that Hurricane Ida just hit the Gulf Coast. What we've seen historically in hurricanes, in large natural disasters, is the storage industry tends to get at least a short-term boost, especially for those properties that are able to open, able to stay operational. So we do expect some of these markets in the Gulf Coast to see a little bit of a pickup. Now, it likely won't stay forever, but as we've seen with other natural disasters in the past, there might be a little boost in demand.
Before you go there, I do want to highlight, like there's a couple of markets here, Spokane, Boise, Reno, and these are markets that like should not be doing well. Okay, they have very high supply pipelines, they have very high supply per capita, and their rents are up and up a lot. And if you look at that and you think through that, Boise, Reno, and Spokane, what's the commonality? They are smaller markets with significant in-migration. And that's what's moving them. And so I also say is, we'd otherwise would say these markets are headed for a fall. I would say they're probably headed for a gentle landing when all the supply kind of comes through. I don't think that the sort of continued migration will be sort of at the same torrent level as it has, but it will provide a soft landing for these markets that otherwise would probably be headed for a crash.
Yeah, that's a great point, Jeff. And I think it'll be very interesting to your point about the migration trends. I don't think we're done here. I think there's continued demand, especially in those markets. But if we go quickly back to a reopening of offices, a vibrant urban core, those markets are positioned in particularly precarious area where they're highly penetrated and a lot of supply. So it could be volatile, but it's going to depend. And we think that demand is going to continue.
I'm feeling pretty good about that demand.
Yeah.
Hey,
So-
Jeff and Chris, quick question
Yeah, go ahead,
came in. Given the construction woes present today, would street rates get depressed when new developments come online because the new developments have been built on increased costs and hence are likely to be under pressure to get stabilized fast?
Well, I mean, that, valid, right? Anything that's being delivered now, right, has the benefit of both higher costs and higher revenues, and they will need to get absorbed, and they'll price to where they need to lease up. So it's really, again, as we've said multiple times, this is a micro market. So it really depend upon when that facility comes in and how much supply it's got to sort of absorb, and it will probably, price itself in order to sort of lease up rather quickly. Those things, remember, most pro formas had put in a 3-year lease up for a 600 to 800 unit, maybe 1,000 unit facility. So there is time, based upon their reserves to get leased up without, crashing the rates to do so. But if you get into year 2, 2.5, then yeah, there's the rents, you would see, those trade areas under pressure.
Yeah, great point. And so this, the data that we're looking at now, again, it speaks to what we've talked about a lot with multifamily and storage. And you look at the gateway markets right there at the top left: Chicago, Manhattan, San Francisco, LA, really quite strong storage rate performance. Yeah. Also the laggards on the multifamily side, still negative growth in Manhattan and San Francisco.
Yeah.
It's coming back, but still negative.
Yeah.
But again, to the point that we've talked about a number of times, if people are moving anywhere, it's a benefit for self-storage, and that's what we're seeing. So to kind of pull things all together on the rate side, street rates are up across the board. All unit sizes, vintages, and property ratings are experiencing good increases. The bigger units are doing a little bit better. I know we're going to talk about RV and boat in a little bit.
Why not do it now? Okay, so one of the things that we were at SSA in June, and one of the things that when I was at the show, I had a lot of folks just talk to me about, given the performance of traditional self-storage facilities and the buying and the consumer expenditures for RV and boat, and the sort of intensity of investment activity, that there was sort of a desire to start investing in RV and boat, dedicated RV and boat locations, which are mostly land plays, honestly. And that hasn't something we had sort of focused on. So we took that input and said, hey, what can we do? So we have scrubbed and identified about 1,000 locations nationally that are RV and boat dedicated. And we're in the process of actually, developing the data for those 1,000 locations. And we expect to add that to our service probably, either between December and springtime next year. It takes us a little while to kind of get all that data together, but we've, heard from the market that there's some value here and some interest, and we're acting on that to enhance our product.
Yeah, and that just speaks more to the demand of storage,
Yeah.
storage facilities, boat and RV. To kind of wrap things up, I'd say, the demand is there. We're seeing record growth rates. I think this is an opportunity for the storage industry, certainly to make hay while the sun's shining, but also we think this is going to continue at least another 18, 24 months of pretty strong growth as the migration story continues to unfold. The growth in demand continues to be there. So let's go into fundamentals, but before we do, we'll launch another poll question. And this one's going to focus on your investment strategy. Oh, sorry, this one is going to focus on street rates and in-place rents.
All right, people are piling in.
So a lot of people saying street rates are growing faster than in-place rents. I think that makes sense. That checks out with what we've seen from the REIT earnings as well, and from a lot of the operators we've spoken with.
ECRI increases, you don't necessarily want to shock people into moving, as it creates further leasing pressure. So it makes a lot of sense that that street rents are going to grow much faster than in place, and I think that's probably what we've seen here.
Yeah.
Okay.
Yeah.
Cool.
All right. Well, thanks everybody. Now we'll jump into what we're seeing on the fundamental side.
Okay. Great.
So we just touched on it. What we're seeing with the REITs overall, we're seeing really strong occupancy. Getting back to the demand story, the utilization story, occupancies are up in most places, and it's kind of a geographical.
And I'd say, well, there is some impact of the eviction moratoria. I'll call it clogging up, supply that would normally kind of get recycled through. This is, I would say, more than that, right? So it's not just the evictions moratorium would explain that. There's absolutely been, increases in demand generally.
Yeah, that upward shift in demand that we've been talking about. Portland, Tampa, Atlanta, Charleston. Now a lot of southeastern markets, but you see some markets, even San Diego, Sacramento, some of these Californian markets as well. Strong occupancy really across the board. So completions, they're pretty much in line with what we've seen last year. Obviously last year there was I'd say a 2.5 month pause when COVID first hit, slowed down the construction industry, but storage bounced back. I think we're again in line with what we're seeing this year as what we saw last year. 2018 continues to be the peak and a modest slowdown, I'd say, in development going forward. Abandonments, again, abandonments seem to be slowing down, dropped about 32% from where they were last year. I think there will always be some level of abandonments going on in the industry, just as deals try to pencil and perhaps there's a little bit too much localized inventory. But overall, the abandonment activity is down, which is another good thing for the storage industry. Where are we seeing, or where have we seen the most abandonments? Boston, that's a story of oversupply going back even before the pandemic. There was certainly demand. It's an underpenetrated market, but also a lot of developers rushed into the Boston market.
So this is more a rationalization of that.
Exactly. And then again, more of a geographical dispersion. Interesting, even Phoenix and Orlando, two strong markets from demand. I think that's more of the micro market play that you were talking about, Jeff. There are definitely pockets in these markets that could be development friendly. there are definitely also pockets of these markets where there's a ton of inventory. And so deals might not have been able to pencil just on the 3 mile, 1 mile radius. So let's kind of jump into our storage supply forecasts. As I mentioned, peak deliveries, we still expect to be 2018. We saw the peak, we've seen a modest slowdown. We expect deliveries to be pretty flat, maybe a little bit of a slowdown. As the industry maintains its strength, it would not surprise us if supply increased. Certainly not. The capital markets are healthy, there's demand. One thing that I'm a little bit cautious about, and certainly operators who've been in this sector for the past 5 to 10 years have seen, there is a little bit of municipal pushback in certain areas, in certain areas.
Restricting supply.
Exactly. So the fundamentals are there. We expect supply to continue to be steady, perhaps increase down the road, a couple of strong tailwinds, but also some headwinds that will probably keep supply pretty steady. Again, you see 2018.
And that would kind of explain, I mean, the investor interest of buying, existing or near existing facilities.
Exactly, and expansions as well. Right. We'll talk about expansions in a bit, but that's a huge benefit on the expansion side.
Hey, Chris, one more question.
Yeah, go ahead, Megan.
Going back to the abandoned projects, is there any feedback as to why these projects were abandoned?
I would say most of the feedback we've seen of the developers that I've talked to, it's all been about how quickly a micro market gets penetrated. And a lot of deals that are in the prospective phase and the planning phase, if they're not aware of other deals that are coming on across the street down the road, they'll say, wow, this is a great area, this is a great market to build in. But then as developments come along quite quickly, and storage is
clearly not our subscribers.
Potentially not our subscribers, Jeff. That is a good point. Storage can be developed fairly quickly, certainly quicker than office, certainly quicker than multifamily. So I think a lot of it is developers saying, wow, this is a good opportunity, but they're not alone. And so then, once
so it's kind of a race who gets there first.
Exactly. And then
if you're late to the party, say, okay, I'll take my chip somewhere else.
Exactly. Yep. That's exactly it.
Thank you.
Yeah, absolutely. So again, looking at our kind of national level forecasts, 2020 completions, about 850 stores, a modest slowdown, and we'll kind of oscillate around that 700, 800 number.
But we are seeing a bit of a pickup in 25, 26 as results have been so good. You expect to sort of this to pop back up.
Yeah, exactly. And then looking at it on a percentage of stock basis, pretty much staying between 2.5% and 4%. That's a pretty comfortable level. Right now, our planned and under construction pipeline is about 8% of stock. So that makes sense that, half of that, a third of that would deliver every year. Well,
this is something new we decided to do.
It is, yeah. So we looked at population forecasts as well as our storage forecasts and said, okay, what markets are likely to be undersupplied? What markets might be oversupplied? And the interesting takeaway here is, you look at Boston, you look at New York, Philadelphia, markets that perhaps don't have as much in-migration as some of the Sunbelt markets, but historically they're under-penetrated.
Right. So there's still a penetration story that's still intact. Let's put it that way.
Exactly.
Right.
And
even with population not growing, even without migration, there's still a story there for penetration.
Yeah, and this also begs the question, I know, Jeff, you and I have kind of jawboned a little bit about what is the true equilibrium point for storage. We've said average of 6.8 net rentable square feet per person. The industry says 7. You look at Boston, New York, maybe it's 4, maybe it's 5, maybe it's 6.
Right.
You look at some of these markets where Reno, Boise, the naked eye would tell you, wow, these are oversupplied markets. It's 16.
And yet there's been a high level of utilization of storage in these markets.
Exactly.
Right? Which, so I think I was interested to see this analysis, but also I'm a little careful in its interpretation, right? Because again, if you looked at the actual operating results, you'd say, well, gosh, Reno, Boise, Spokane are doing just fine. Thank you very much. But I think this kind of talks to the fact that the pipeline will probably reasonably get absorbed okay? And then, it's more of a local understanding of, is there a higher utilization? Is there sort of more toys that are being stored here? And that's what's driving some of the others are more seasonal nature to the population. What makes these particular 3 or 4 markets different than everybody else?
Absolutely. Absolutely. And so now again, we look at our major markets, some pretty robust pipelines in certain areas, New York, Philadelphia, markets that we just talked about as potentially being undersupplied. That's a strong supply response.
But one thing I do want to highlight to you is there were some markets, if you look at back a couple of years ago, Denver and Nashville were like poster children for like massive supply pipelines. And they did struggle. And as you look at this data here, it also looks like the transparency of understanding what that supply pipeline is has brought the supply pipeline back into some level of alignment, right? And so those markets have now kind of rebalanced.
Yeah.
Okay?
I think that's a really important point about transparency too. You could say the same thing about the Texas markets, even a few years before Denver and Nashville, excuse me. I remember being at a Texas SSA and they were saying, there's so much new supply, we might never lease up a storage facility. Now, we've certainly seen the demand return, but to your point, Jeff, about transparency, we've seen that supply response taper when you can see what significant supply does to performance. So we talked a little bit about expansion. There's still robust expansion activity going on. And again, Jeff, I think that speaks a little bit to the perhaps restrictive zoning or challenges that certain municipalities, not everywhere, but certain municipalities might be hesitant to new development. So expansion activity is a great way to say, look, it's already a storage property. We're just going to expand. The land's there as well. Conversion activity has declined a little bit in 2021. I think those numbers are going to bounce back, whether it's the remainder of this year into next year. We have seen a lot of retail go under, and a lot of those locations would be great storage opportunities.
Because they are, if you talk about a Class C mall, right? There's people around it. And the population's already there. The land may not have another sort of appropriate use. And so again, if you can hive off 2 acres for self-storage facility, particularly in the context of some other development going on, you can get that through and implement.
Yeah, absolutely. Again, switching over to the tertiary markets, very strong pipelines in places like Spokane, Boise, Reno. We've talked about those. But at the same time, in some oversupplied places in Oklahoma City and Tulsa, we've seen the transparency pull back a lot of that development.
Hey, Chris, another question came in.
Go ahead.
With growth in tertiary markets, can you talk about the ease of developing or the NIMBY effect of getting new self-storage developments done?
Well, I mean, I think, look, when you're talking about tertiary, we're primarily talking about the size of the metropolitan area. In general, right, the southeastern, Mountain West, and Texas markets have been, as in many other areas, business friendly, and self-storage just being another one of those businesses for which is business friendly. It's been easier to add. Also, in a smaller market, there's just the fact that there's economic development, is a little bit more welcome. In a larger metropolitan area, you may face more development restrictions, just like, quite frankly, if, in a New York or a California or markets that are traditionally restrictive of any kind of development across any asset class, self-storage will just be another one. And the fact of the matter is self-storage has less of an employment impact. It just does. It generates tax revenues. Okay. And so in areas that are restrictive in new development, the case is often made that it's either going to take a property that's not generating any tax revenue into a conversion and generate tax revenue, or it's a marginal piece of land that doesn't really have any higher and better use. And so it can be converted from vacant land or abandoned land into tax generating revenues for the municipality. And that tends to be the sort of the angle, the story that enables that development to occur. So
thank you.
Sure, you bet.
Looking at the conversion, data that we've seen here on the tertiary markets. Again, conversions off a little bit compared to where they've been.
It's still higher than the major market.
Higher than the major markets. And again, we expect that to increase through the balance of this year and into next year as well. So interesting little bit, and I know we already talked about RV and boat, but thinking about transactions, we've really seen an increase in the value. Transactions activity, overall volume has declined, but valuations continue to increase. We've talked a lot about the influx of new capital,
Significantly.
institutional capital.
And also I see transaction activity actually very much picking up.
Yeah.
So I think it was more of maybe a lag, but if you look at sort of the investor interest in the sector and the desire to deploy that capital quickly, I expect transaction activity to meaningfully increase over the course of the next 18 months.
Yeah, and I think that's a continued effect of the growth of self-storage now as a core.
And if you look at that in terms of price per square foot, right? As where the rents are moving, so too are the values, right? The Class A are actually fetching higher prices and a higher growth of prices, Class B and Class C assets, older assets who are not able to garner as much of the consumer interest or the new consumer interest aren't doing nearly as well as the newer assets.
Yeah, and I think that's a lot of where the institutional capital is going. It's into those Class A assets. So again, looking at some of the largest buyers, certainly the REITs have been active, some private owners as well. A lot of institutional capital, as we've mentioned, that's entering the space.
And quite frankly, Sparebox is basically a funded by institutional capital that's going to the space, and a lot of these are sort of longtime players who are adding to their holdings.
Yeah, exactly. A lot of private owners have been the most active sellers. Again, whether it's to REITs or to institutionally backed other private owners.
And for me, this is more of a question of, there's a normal rotation of your fund. There comes a time when you have to create a liquidity event. The Kane Anderson folks have been in storage forever. I suspect they'll attempt to reload, as they cycle through, create returns for investors, build a track record, raise the next fund, and go on to the next story.
Yeah, and I think, again, this is more of an example of how storage is viewed across asset classes. It might not be a core asset class with office and industrial, but it's pretty darn close.
Well, I think it's growing, and it's becoming more of a star amongst what's called the alternative real estate asset types. And I would put self-storage in them. Data centers would be one. I'd put manufactured housing in there. So there's another one of these sort of niches, right, that have generated very high returns. We particularly like storage because of the defensive nature of the asset type. It's done, again, I think we've done very clearly, it does well in downturns as well as upturns, as long as the development cycle doesn't get out of hand.
Exactly. So again, these are just some headlines. Many of you have already seen a lot of the transaction activity. Public Storage, very active. Heitman, Madison Capital.
And KKR finally, began to deploy their capital. They're a new institutional investor.
Exactly.
In the asset.
So just kind of bringing things all together. I know we've got about 10 or 12 minutes for some questions as well, but strong occupancy, strong demand. Development is steady. Again, we don't see it rapidly increasing. We don't see it rapidly declining. And I think that's really good news, actually, for the industry. Steady development, continue to drive or continues to support the demand that we're seeing. I think that should be good news for quite some time.
Yeah, I know we're hearing from the lenders too, that they like the asset type. Yes, costs have gone up. Steel has gone up. The sector has responded at least not from a development, from an operations standpoint, of continuing levels of automation. The notion of a staff-less office facility is not heretical anymore. It was sort of, it's gaining traction. And that is enabling kind of some of the underwriting deals to work when you're continuing to pull out costs. And taxes continue to be one of the largest elements in the cost structure. And that's where I think we thought we'd see a lot of pressure, in municipal taxes, but the municipal finances have actually held up pretty well in COVID due to, quite frankly, government largesse, which may turn up in inflation. But as a result, local property taxes haven't gone completely haywire, which we thought they would. Not to say they're not under pressure, and that is a big concern for self-storage facilities, but there have been offsets in other areas of expenses.
Yeah. So as we wrap things up, and Megan, we've got a couple of minutes for questions, but where do we see kind of our house view? The economy is strong, as Jeff mentioned. Storage demand and utilization is really, really strong. Elevated levels that we haven't really seen in history in this industry. As a result, street rate reaching historic levels in most markets, growth in all markets, certainly some faster than others, but really, really good news on the street rate side. Supply, as I mentioned, is in a good, healthy place. And investor interest is really strong. You know, as we talked about, a lot of new entrants to the storage market, a lot of existing entrants want to expand their portfolios, as we saw in our first poll question. So I would say, Jeff, that the outlook for storage is pretty good, certainly in the short term, and I would say strong even going into the intermediate and long term as well. So Megan, I'll turn it over to you. Any questions? And as we look here, we've got a couple of upcoming events. Yeah. Jeff will be out in Vegas next week, and
look forward to seeing as many of you as I possibly can. We will be there.
And for those in other asset classes, we've got a number of webinars coming up throughout the fall as well. So we'd love for all of you to join us going forward.
Megan, any questions that we should answer?
Hey, Jeff and Chris, can you hear me?
Yes, we can.
Sorry about that. I had some internet troubles. Okay, first question. Can you remind the participants the difference between prospective versus planned?
Okay, super. So we break our new supply pipeline into 3 phases, right? So I'll go the sort of under construction's easy, right? Dirt's getting moved, and it's happening, all right? Planned is where a formal plan has been submitted to a planning or zoning authority in anticipation of a building permit. And we will pick up the building permit when it's issued, but it's a pre-permit phase. Prospective is earlier still. A conversation has started with the planning and zoning authority. The land has been tied up, but no formal plan has been submitted. Their financing isn't in place, and it's early stage. And we do see projects fall out in this area where, where things are moving, but they're not going to happen probably. Once a facility gets into the planned phase, it's highly likely it's going to get done at some point. There may be a delay every now and then, but once you've got the plan submitted, it's gonna get done.
And that's often where you see the financing tied up as well.
Financing, so by the time it's planned, the financing is tied up, the debt's in place, the equity's there, and the deal is viable and is highly likely to get done at some point.
Great. What do you predict will happen with rates after the 18 to 24 months of strong growth? Will they stabilize or drop?
This is going to depend. I mean, this is sort of I wish I had a crystal ball. It will depend to the extent of the supply response. Okay. I would expect that we would see street rents, kind of dissipate in their growth, right? And if supply kept coming, we could be back where we were in 1819 with, declining street rents. Now, remember, right? You're still going to have, for facilities that have been full, very high rents, and you're still going to get ECRIs there. So the overall financing, and financial health of the industry is still going to be enormously in good shape. But I think it would be if you're underwriting a deal today, like you can't underwrite 15% rent growth for 5 to 7 years through your whole period. That's just not going to happen. Okay. Much as I wish we all think it would, it'd be great if it does, but I just don't think you can go and buy an asset on that assumption. You're going to get yourself in trouble. I think you have to sort of start tailing those increases down after in year 3, year 3, 4, 5, and 6 of your hold. And you may see a flattening out of rent growth in year 5 and 6. And you should do some sensitivities in your models of what does that look like for new street rents. Again, that really only nails you if you're going to start a project in 3 years and you're leasing up into the teeth of a problem. Anything that's going to get done now, you're probably going to get through it and be okay.
Great. What can derail the self-storage industry? Are there any demographic trends coming down the road that are concerning?
Well, we have an aging population. And so that actually is kind of a good thing for storage. So I don't see the demographics side of it. I don't see birth rates exploding anytime soon. So I don't see that happening. I don't think anyone could have, or no one predicted the level of work from home efforts, right? So what would mitigate some of the demand would be that there's a sudden rush back to the aggregated urban cores, right? That would be because storage is benefiting from that movement. If that suddenly stopped, right, and reversed, and more consumer wages went to sort of paying rent in high cities, that could do something. It's just highly unlikely, is what I would say. Then I always ask myself, what do you have to believe in order for that scenario to come true? And I walk through the logic of that. I have to believe a whole lot of things that I just think are very unlikely.
And the other thing I'd add to that, Jeff, is we've talked about storage being such a sticky industry. People who've been storing now, new storers who've been storing now for 12, 18 months, it's very easy for them to, even if they do go back to their pre-COVID lifestyle, say, yeah, I'll leave that storage. And
I would say, particularly if it's $1,000 a month, probably not. But if it's $150,
$200, yeah.
Is it worth sort of, should I dump the stuff that I had? Is this stuff I had still of value? So there tends to be a greater level of stickiness than one assumes, though it's very clear, right, that from operating results, we know that the churn rate is 5 to 7% a month. It is a high churn rate relative to other asset types. There's no question. Okay. And so that is true. Okay. So if you're like 5, it's like it's 6% times 12, you're at a 70% annual churn rate. That's high. Okay. Single family rentals, 30%, multifamily rentals, maybe at 50. Right. So storage does churn. What we're talking about here is, apart from the normal churn, there's a stock of people that just kind of let it hang.
Yep.
Okay.
Absolutely.
And quite frankly, that's where most of the margin in the storage industry comes from, is the folks who just kind of let stuff hang. Okay. But I would not ignore the fact that storage has traditionally a very high churn rate. That's why the advertising expense in storage is so high. You have to spend a lot of money to generate demand. And up until COVID, Google was making a lot of money on storage keywords, a lot of money. And we had seen, advertising expenditures in where it's available, and the REITs be rising, 50, 60%. That's probably backed off a bunch. So that's actually probably helped the P&Ls of all storage operators, that not having to spend as much on storage, because they can get the demand elsewhere, or they don't have to keep spending in storage on advertising costs. Any final questions?
Yeah, we have a few more. How much do you think the rampant material cost run-up impacted projects being abandoned?
I don't think there's, again, if I was going through this, I also have 20% rent increases. So I don't think it's as much of an increase in the costs as much as saturation.
Yeah, and we were seeing abandonments in 2019, early 2020, before COVID and before the significant increase in costs. Maybe a project here, maybe a project there was impacted by cost, but to Jeff's point, I really think it was more based on saturation, more based on the supply and demand, perhaps, imbalance in certain micro markets rather than the cost side.
Sure. Have you seen any distressed sales over the last year in self-storage?
No.
Many people wish, but I don't think we've really seen any.
No. And no, because you in order to have a distressed sale, you need somebody in deep yogurt, either from a loan maturity or a lease up that failed, or it hasn't materialized.
Yeah, and to be honest, if we weren't seeing distressed sales and we weren't at the height of the supply shock of 2018, 2019, I don't expect to see that, the fundamentals
soon.
allowing that for the next couple of years.
Right.
What is your outlook on the impact of the eviction ban for renters and burgeoning pre-foreclosure in courts on rent per square foot and fresh starts and conversions?
Yeah, so it's a good question, right? And so it's a little bit of, if you unpack this a bit, the eviction or the likelihood of incidents of evictions, but I'll focus on rental housing where I'm most familiar, okay, is been at the lower end of the market, okay? If you look at the apartments that are managed through I'll call it the National Multifamily Housing Council's kind of rent tracker, which we contribute to, professionally managed apartments really have seen a marginal 1-2% increase. Now, if you are running 500,000 units, it adds up to some real dollars, I will admit to you. But as an industry revenue stream overall, it hasn't been material. Where it has been material, and I saw some data that smaller operators have collected only about 85% of the rent. That's 15% that they haven't collected, and that's been building over time. Those folks are going to be most impacted by evictions and private landlords needing to clear out their rentals so they can sort of release them because they're not generating any income and they're still on the hook. But those people are not the people who have tended to use storage. Storage, again, is not used. Even if we looked at this, the data in the survey was a third of the movers, right? So in order to move, you have to have income to move. A third of the movers use storage, either on one end or the other. And that tends to be at I'll call it a mid to high level demographic, particularly of the Class A brand new facilities that we're talking about rent growth being material. So if you peel back, look at who the renters are, the fact that they really have not been the ones who've been impacted. Okay, and if you're running a class sort of older facility, older storage facility in a less affluent area, then there is a possibility, right? But those folks, they probably didn't default on their rental; they were defaulting on their rent, right? They're still paying the storage facility because they had their stuff there they want to keep and they don't want to lose that. So I think it will not have a huge impact on the self-storage industry. There is some, okay, but I don't think it's a huge impact. And in many things, what unfortunately my perspective is that the eviction moratorium has, while benefiting some people who have not paid rent and have lived wherever they're living, it has created a reduction in effective supply for those people wishing to come into the market and find a new apartment rental, and that has been affected in new rent pricing. And so that is a sort of well-worn economic outcome of the law of unintended consequences, and that there is at the end of the day, no free lunch.
Okay, great. And then we can end with this question. If there's anything that we missed, please feel free to reach out to us. But
sure.
The
or you can
final
come out and
question,
see me at SSA.
yeah, absolutely.
Yeah, go ahead.
The final question will be square feet per capita data measures supply, but how can acquisition companies gauge demand in their target markets?
Well, I mean, the best way, it's a good question, right? You can manage supply. How do you manage demand? Well, certainly you can be looking at the levels of Google searches, right? That's a very easy way to do it. You also can look at what we're seeing with migration. You can look at apartment rents, right? In terms of where the movement of apartment rents is. So you can look at other areas. Again, Google searches for storage are the easiest to look at. Apartment rentals is sort of a secondary factor. Go find out how much it costs to rent a U-Haul into the area.
Would you look at?
That'll tell you something.
Would you look at housing development, either single family or multifamily development, as potentially a driver for demand?
It is a driver of demand for sure. But the question is that's depending upon when it delivers, right? and also what the lease up experience has been in the area and what the rent growth area in the area has been. Or, you know, home values have gone up so much that it's really hard to sort of unpack like demand for new housing, you know, because if you're just recycling sales, right, that's not creating new households in an area, right? And what we're seeing is driving out of this demand is churn, right? Like, so not only new households in an area, but the rate of churn in those households. So I suppose you could look at the rate of churn or rate of home sales in a particular area from the county recorder, the tax assessor. How quickly homes are turning over would be a source of demand for storage.
Right. Well, thank you all for joining us. And Megan, if you could wrap us up, that'd be great.
Sure, absolutely. Thank you for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to subscribe to any of our free research, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Jeff Adler and Chris Nebenzal for their commentary today. I would also like to thank Jeff Muth and Mary Chu for running the web program, and Maddie Harper and Claire Anhalt for their contributions to the content. This has been a production of the Matrix Division of Yardi Systems, Inc., copyright 2021, all rights reserved. This concludes our broadcast. Thank you.